Hey everybody, how's it going? Thanks for showing up to today's live workshop. I am super excited to introduce to you guys today Mr. John Bowens. He is the head of customer education and success over at our friends at Equity Trust. And he's going to be talking all about how to use creative retirements accounts. So I think a lot of you probably hopped on this call because like you have a 401k or an IRA and you're thinking about, I've heard maybe how I can use this to, buy my next investment property, but I don't know the details. I'm nervous. There's a lot of different types of accounts. There's a lot of different types of questions. And so I thought, why not bring on an expert, someone who's been doing this for years and teaching people all across the nation, who's done hundreds of workshops on this, who's written a book on this to come and answer these questions. So John, man, I'm very honored to have you here. Thanks for joining me today.
Hey, thank you so much, Brady. Really appreciate it. And I love what you guys are doing at Rent Ready. Keep up the great work. An associate and a friend of mine, he has a PhD in real estate, in fact, and he started.
Oh, wow.
He started some PhD programs with a couple major universities, and he has over 200 rental properties himself. And one of the things that he taught me, I'd consider him to be one of my mentors as I'm a landlord investor myself. And he taught me years ago, he said, John, the difference between good and bad property management is anywhere between 7 to 8% return. And that is analysis that he did over hundreds of thousands of residential rental properties, apartment buildings, and 1 to 4 family. And I thought that was interesting, always stuck with me. And I think that you guys, from a technology perspective, you're helping landlords be able to facilitate, provide a better quality product to their tenants, and just doing some really great things. So big thank you to you guys and what you're doing. And on behalf of Equity Trust, we're really grateful to be part of the Rent Ready universe and community, and looking forward to delivering this material.
Yeah, absolutely. Thanks for the kind words, man. We're happy to partner up with you guys. And yeah, our whole aim is to kind of simplify the whole self-management process and get some of that 7-8% return back for sure. Glad to hear we're doing that. Everybody, if you're in the chat right now, thank you for hopping on. Let us know. Some of you already have been, but let us know where you're tuning in from. What do you do in real estate? I'd love for this to be an interactive call. John's going to present for a little bit, and then we're going to be doing some Q&A. Some of you put in great questions in advance. We'll tackle some of those, but also put your questions in throughout the webinar as they pop up. Don't wait to put them in, and we'll tackle some of those live at the end as well. It's going to be a great Q&A. But John, I'll pass it over to you. I would love to hear one thing I didn't mention. Well, I did mention you wrote a book, but I'd love to hear just real quick before you dive into the meat of this, like what that book is about and kind of the whole sentiment behind what you do at Equity Trust and how you got into this.
Yeah, absolutely. So I came to Equity Trust about 20 years ago, and my background is in finance and then also real estate. And nearly 20 years ago, I met our company founder, Dick Desich, who's widely known as the pioneer of the self-directed IRA industry. That is self-directed IRAs investing in real estate. And he's a real estate investor himself. And so I learned from him. He became my mentor, and nearly 20 years later, still doing it. And I've had the opportunity to educate and train over 400,000 individuals in over 400 workshops. I've had the opportunity here on behalf of Equity Trust to be able to work one-on-one with thousands of individual investors. And then in addition to that, I'm a real estate investor myself. I primarily focus on single-family rental properties, but I also loan money secured by real estate. So that's what I do on a personal side as far as real estate is concerned. And then here at Equity Trust Company, doing a lot of education, working with our internal and external partners. And it's been a lot of fun. I've gotten a lot of fulfillment out of it. And really the spirit of everything that I do and our organization does is helping individuals take control of their retirement accounts and invest beyond Wall Street. And that's why when I wrote this book, we decided to name the book Wealth Beyond Wall Street, a field manual for self-directed IRA investing. And so that book goes chapter by chapter, a lot of the tactical kind of meat and potatoes. And that's what I intend on doing today for folks, is really getting into, in a learning style session, how individuals can take advantage of what I call the 4 tax advantaged accounts. And this will include planning for 2025 and 2026. That will encompass traditional IRAs, Roth IRAs, HSAs, and solo 401k plans. We'll then go into how to fund the different self-directed accounts. And then lastly, we'll go through, and this is where we'll spend a bulk of the presentation today, is actually showing some real world case studies and examples, because I think that people learn the best through seeing it through the lens of other investors. So myself as an investor, and also working with thousands of individuals just like myself, what I intend on doing is actually walking folks through the different types of structures that are used, from partnering multiple accounts to also utilizing LLCs, solo 401k plans, buying individual properties, as well as lending secured by real estate.
Nice. I love that. Thank you for the intro, man. I didn't do you justice, so thank you for covering your background and expertise. We've got a lot of people in the chat, which is really cool to hear. We got Virginia, California, Knoxville. We've got East Texas. We've got Connecticut. People doing multifamily, single family, some full-time investors, some doing this on the side. This is awesome. People from all over. Sweet. All right. Well, I'll kick it over to you, John. We got a lot to cover.
Excellent. Appreciate it again, Brady. All right, folks, I'm going to jump right into it. And of course, Brady, if you have certain questions that are coming up, you want to interject a little bit throughout the formal presentation, you're welcome to do that. For everybody that's on, welcome. Feel free to put your questions in the chat box. I'll try to keep an eye on those, and then certainly leave a little bit extra time for open forum Q&A. So just hopping right into it here, you'll see here that most individuals, in terms of retirement accounts, IRAs, 401ks, even we could add in there HSAs and solo 401k plans. Most individuals are on the left-hand side of the screen. So they're in a they control environment. Most financial institutions will only allow you to invest in publicly traded assets like stocks, mutual funds, ETFs, CDs, treasuries, annuities, other traditional products. In order to be able to break free of, call it that Wall Street box, and go beyond Wall Street and invest in Main Street, that's where you would transfer or roll over your existing retirement plan into what we call a self-directed IRA. Self-directed is an industry term. So you're not going to find in Section 408 of the Internal Revenue Code, you won't find in the other applicable sections of the actual tax law the term self-directed. Just remember that self-directed is an industry term. It just indicates to you that you can take control and you can invest beyond Wall Street design products. Now, you do have to make sure that you're working with a qualified private market, or sometimes also called alternative asset custodian. All right. You got to find an alternative asset IRA custodian. Remember that most financial institutions aren't going to allow you to hold a residential rental property or a real estate partnership or a private equity deal or cryptocurrency in an IRA with them. They just don't have the pipes and plumbing, the personnel, and the education to do that. So the first step of the process is identifying a qualified IRA alternative asset custodian that can hold alternative investments. So once you can kind of break free of that, you can transfer or roll over your existing retirement plan into a self-directed IRA, and that could be all of your funds or just a portion of your funds. One of the most common questions I get, Brady, is do I have to move my entire retirement portfolio into a self-directed IRA? And the answer is you don't. Some folks want to start off with a smaller amount of money. They don't want to break their entire portfolio out of the traditional stock market. They want to peel off a percentage of it so that they can gain some exposure to a non-correlated asset class such as real estate that is not correlated to the traditional financial markets. And so once they're in that position of transferring or rolling over their funds into a self-directed IRA, or could also be a self-directed HSA that we'll talk about, or even a self-directed solo 401k plan, then they can begin directing those funds for a real estate transaction. And I'm going to break down step by step for folks through case studies exactly how that works and what that looks like.
Awesome. So I love it. And I know that was one of the questions we had coming in advance. So thanks for answering that.
Yeah, absolutely. So the 4 tax advantaged accounts that we're going to crawl through here for everyone so they can understand how these work and how they could potentially relate to them. And when I look at these accounts, I think it's really important, Brady, for everyone to understand that these are not just retirement accounts. A lot of times when we have the conversation about self-directed IRAs, or as I'm presenting and putting on these different classes, some folks think that I'm going to be talking just about retirement accounts. I look at these not just as retirement accounts, but I look at these as highly efficient tax planning tools. I also look at these accounts as legacy and estate planning tools. For example, with a Roth IRA, I have the freedom of tax-free growth and tax-free distributions in my retirement. If I leave my Roth IRA to my children or grandchildren, they can continue to grow that account for 10 years tax-free in a Roth account. Just as an example, there are other accounts that we're going to talk about as well. So number 2 is legacy and estate planning. And then number 3 is creditor and bankruptcy protection. So that's going to get nuanced depending on the state that the individual's in. But ultimately, it's important to understand that there is inherent creditor and bankruptcy protection associated with these tax-advantaged accounts, these tax-favored accounts. And when you pass away, these accounts avoid probate. So as long as you list a death beneficiary, that account is treated just like a trust. It's left to a child or grandchild or a spouse, a surviving spouse, whoever you name as the death beneficiary, and it avoids probate. So I think it's really important at the beginning of the conversation for people to understand that these are not just retirement accounts. There's so much more than just that. And I'll mention that with a Roth IRA, interestingly, you can actually draw from a Roth IRA prior to the age of 59 and a half. There's something that I like to refer to as the Roth IRA layered cake approach. And what this comes down to is the ability to be able to distribute from a Roth IRA up to a certain amount of the balance of that Roth IRA prior to the age of 59 and a half without paying any tax or penalty. And a lot of people don't know about the exceptions to the rules. So there's the high-level guidelines and the tax law, and then there's exceptions. And understanding those exceptions is where oftentimes a lot of tax planning opportunity lies. But a lot of people don't know about that because they're not studying this. And traditional Wall Street advisors and tax consultants aren't talking to their clients about this. And so that's why I like to introduce those types of things to the conversation. So for example, Brady, you're obviously under the age of 59 and a half. Let's say you have a Roth IRA, you make contributions to the Roth IRA, maybe you convert some funds from traditional to Roth, and then you grow the Roth IRA to $400,000 through real estate investing. Well, guess what? Even prior to the age of 59 and a half, you can distribute from amounts that you contributed and amounts that you converted from traditional to Roth. I call this the Roth IRA layered cake. And the reason why I bring that up is because, again, a lot of people look at these as just retirement accounts that I can't touch or do anything with them until I'm the age of 59 and a half. And that's not necessarily the case. There's actually ways to gain access to those funds prior to 59 and a half and avoid penalties. And in addition to that, the ability to be able to pay taxes once and never pay taxes again, be able to invest in real estate, be able to do private money lending transactions secured by real estate joint ventures, partnerships, buying on owner financing, selling on owner financing, sandwich lease options, all of the different types of real estate strategies that so many people are accustomed to when they get introduced to real estate, you're going to find, for the most part, you can do with these different self-directed accounts. So let's take you through each one of these self-directed accounts so you can understand them a little bit better. From a tax perspective, there are what we call pre-tax accounts, and then there are post-tax Roth accounts. So on the left-hand side of the screen here, you see traditional IRA. On the right-hand side of the screen, you see Roth IRA. When we discuss the solo 401k plan, you'll learn that there's a pre-tax side to the solo 401k plan and then a post-tax side to the solo 401k plan known as a Roth component. Sometimes we call these buckets. So within a solo 401k plan, you have pre-tax bucket and you have post-tax Roth bucket. Traditional IRA compared to Roth IRA. A traditional IRA, you're contributing money and you're getting a tax deduction. You have tax-deferred growth. Tax-deferred growth is good, of course, but eventually when you distribute money from the traditional IRA, that's when you pay taxes. What you learn when you study tax laws and when you study these retirement accounts and you study tax strategy, you find that it is all trade-offs. There's always a trade-off when it comes to tax strategy. The trade-off here is this. You get a deduction now when you contribute to a traditional IRA or the pre-tax side of a solo 401k plan. But what happens, because you get that benefit now, you have to pay the taxes when you distribute. The analogy we always use is you either pay taxes on the seed or you pay taxes on the crop. So with a traditional account or traditional side of the solo 401k plan, because you didn't pay taxes on the seed, you have to pay taxes on the larger crop. The Roth IRA is opposite. You make a contribution, you don't get a tax deduction. So there's your trade-off. Your trade-off is no deduction now, and then what you get back for that trade-off in the future is tax-free distributions. With a Roth IRA, you get the taxes out of the way now, you have no taxes on your growth, and you have no taxes when you distribute money from the Roth account. And that same principle applies within a solo 401k plan. I'm going to show you how with a solo 401k plan, you can contribute up to $72,000 in tax year 2026 to a solo 401k plan. So for those of you that are self-employed, solopreneurs, real estate agents, just call it self-employed persons out there, I can show you how to contribute up to $72,000 this year in 2026 to a solo 401k plan. And 100% of that money can go in after tax into what we call the Roth bucket of the solo 401k plan. We do this through a strategy that we call the mega backdoor Roth contribution. So if you ever see any articles out there about mega backdoor Roth, I'm going to show you exactly what that is. And if you're of the age of 50 or over, there's something called a catch-up contribution. So instead of just 72,000, we'll actually show you how to get up to 80,000. In addition to that, you can do your annual IRA contributions. Now, last item on this slide is Roth conversion. So maybe you're on this call and you have a significant amount of cash assets in a traditional IRA or the pre-tax side of a 401k or 403b or TSP or other employer plan. And you're saying, hey, I like the idea of tax-free growth and tax-free distributions with a Roth account. And I like the idea from a legacy and estate planning perspective, the ability to be able to leave tax-free money to my children or grandchildren. But how do I get my money from pre-tax to Roth? Well, there is a way to do that. It's called a Roth conversion. And we're going to talk through what a Roth conversion is, what it could potentially mean for you, and show you the tax brackets and how that might relate to your individual situation. Now, as I say that, I want to make sure I'm very clear with everyone that I'm here to provide information and education, not tax, legal, or financial advice. And so when we talk about the nuances of these different tax strategies, I'm going to ask you to work with your tax consultant, your CPA, your other financial professional as you navigate these different strategies. My role here is to educate you on the different techniques and strategies, not to give advice, and then you go to your financial professionals in order to put the pieces of the puzzle together. Okay, to show this in a graphical numerical representation, we'll just use a very basic time value money example. In this example, if I put $6,000 away every single year for 25 years and I apply a compounding return, you can see there, of 12%, I factor in taxes of 30% and taxes of 20% when I distribute. In a taxable environment, because I have the erosion effect of taxation, I have about $601,000 saved. If I compare that to a traditional IRA, remember pre-tax, I get a deduction going in, I get tax-deferred growth, and then I have to pay taxes when I withdraw. With a traditional IRA, you'll see close to $900,000 in savings. Comparing a traditional IRA to taxable, I have nearly $300,000 in tax savings. So tax-deferred, better than taxable. And then we look at a Roth account, a Roth IRA, or the Roth component of your solo 401k plan. All of your growth is tax-free. You get the taxes out of the way on the seed. And then when we distribute, we pay no taxes. And you'll see there the end result is $1.117 million in the Roth IRA. Comparatively to the traditional, that's over $200,000 in tax savings. Roth IRA compared to taxable is over $500,000 in tax savings. Now, maximizing the funding of these accounts. Let's go through contributions and then rollovers and transfers from other retirement plans. I think it's really important as we remain very diligent and vigilant in our retirement planning. We have to look at not just how we can roll over money into a self-directed IRA and then invest in real estate, private money loans, other investments, call it non-correlated alternative investments. But in addition to that, how do we make our annual contributions? How do we continue to fuel the tax-free dollars? One of the things that you'll hear me say quite frequently is pay taxes once and never pay taxes again. Back when I was 15 years old, I started working at a hardware store. And I've grown up around small business owners and entrepreneurs. And that's how I've operated my entire life. Working for Equity Trust, having my own side business, growing up around self-employed individuals and entrepreneurs. And here's what I observed from the age of 15. Most self-employed individuals and entrepreneurs, they try to get themselves to zero every single year, right? And we have this vicious cycle of we try to take ourselves to zero, we pay taxes, and then we invest and we pay taxes again, and then we try to figure out how to do cost segregations and bonus depreciate everything and buy vehicles, and like it's just constant, right? And don't get me wrong, that always is going to be something that we do from a tax strategy perspective as small business owners and entrepreneurs. I don't want to discount everything that I just said. But what I want to encourage folks to look at is with these tax-free retirement accounts, what we can do is break free of some of that kind of vicious cycle, right? And instead of paying taxes over and over and over and over again, instead we could pay taxes one time and never pay taxes again. And when I say pay taxes one time and never again, specifically, I'm talking about a Roth IRA and a Roth solo 401k plan, but I'll also add in there the HSA health savings account. And so to conclude on this slide, I want to show you how to maximize contributions every year and encourage you to do that. And you could do that now, even still for 2025. I'm going to show you in just a moment how you can contribute for 2025 and 2026. So the year 2025 is not over. For those of you that are listening to this right now live, or you're listening to the recording before April 15th, you can still contribute for 2025 up until April 15th. And then we have the rollovers and transfers again that we'll talk about. So traditional IRA and Roth IRA. How much can you contribute on an annual basis to a traditional and or Roth IRA? So it's going to be $7,000 for 2025, as long as you get that done by April 15th. So $7,000 for 2025 when you're under the age of 50. If you're 50 and over, you get a $1,000 catch-up contribution, which will bring you to $8,000. And then you'll see the 2026 contribution limits there, $7,500 when you're under the age of 50, $1,100 catch-up contribution if you're 50 and over, for a total of $8,600. Now, some frequently asked questions that I get at this point, Brady. Number one, if I have a spouse that's not working, so let's say I'm working, I have W-2 income, I have a spouse that's not working, they don't have income. They don't have self-employment taxable income, like 1099 income. They don't have W-2 income. As long as we're married filing a joint tax return, we can do what's called a spousal IRA contribution. You can go to IRS publication 590, and it's very clear. If you're married filing a joint tax return, one spouse's earned income can support the other spouse's contributions. It's a separate IRA, but that puts you in a position as two spouses to be able to get more money into retirement. And I would encourage folks to think about that.
So in other words, even with one income, you can double the contributions. So for me and my wife, this would be $1,500 for the year of 2026 in contributions. Is that what you're saying?
You got it exactly. Yep.
That's awesome.
Yep. And to add to that, Brady, if I was working one-on-one with you, here's what I would do. I would look at between you and your spouse, okay, do you want to contribute to a traditional IRA or do you want to contribute to a Roth IRA? Now, I can't give direct advice, but what I would say is I would encourage you, because you obviously have a number of years until you turn 59 and a half. There's a significant opportunity there from a compounding interest in the absence of taxation perspective to have your money in Roth, invest with Roth, and all of your growth is tax-free. And if you really needed to, the principal amount that you contributed to the Roth, you could always take out if you had an emergency situation and pay no taxes or penalties, even under the age of 59 and a half. And that's that Roth IRA layered cake strategy that we talked about. Now, I'll take it a step further with you, Brady, using this as an example. This is a good scenario to go through. The next thing I would do is I would say, okay, you can't contribute to a traditional IRA and a Roth IRA separately, okay? You got to pick one of the two or combine between the two you can't exceed these contribution limits. And obviously, we see the advantage of Roth. However, there can be situations where your income is too high to contribute to a Roth IRA. These are what are called modified adjusted gross income limits. Now, not to get overwhelmed by what is MAGI, most people's modified adjusted gross income is their adjusted gross income, your AGI. So just think AGI for the purposes of this part of the conversation. If you make too much money, then you're not allowed to contribute to a Roth IRA. So, for example, let's say I'm working with Brady and his spouse, and I'm not going to have him divulge his personal financial situation. But let's say I'm working with Brady, and I say, okay, Brady, are you married filing jointly? And he says, yes, we're married filing a joint tax return. And Brady wants to contribute for 2026, and he doesn't want to wait until next year. He wants to do it now. Why wait until next year? Why not contribute now and take advantage of about 300 days of compounding interest in the absence of taxation? That's the concept here. And so he's married filing a joint tax return. And let's say, for example, that between he and his spouse, he is over $242,000. What's going to happen is he's going to be told by his tax accountant that he's not allowed to contribute directly to a Roth IRA because he's over the income limits. But here's the good news. Number one, we're going to talk about this in a moment, he can establish and contribute to, providing that he's qualified, a solo 401k plan and contribute to the Roth side regardless of his income. Number two, he can do what's called a backdoor contribution. So what Brady would do in this case for both he and his spouse is he would open a traditional IRA and a Roth IRA at the same time. He would contribute to the traditional IRA and then immediately do a Roth conversion over to the Roth IRA. None of this was possible until the law was passed in 2006 that made this all possible. So this is what we call in the industry a backdoor contribution. I work with folks every single day that have been told for years and years that they're not allowed to have a Roth IRA because they're over the income limits because they've never learned that they could do this backdoor contribution. So that's the backdoor contribution.
John, that's super interesting. So I'm curious, what's the timing if you were to do the backdoor contribution? Like how often would you contribute to the traditional IRA and then have it move over to the Roth IRA? Is that a one-time thing or once a month? What does that look like?
You can do it multiple times a year if you wanted to, but what most folks do just for ease and be able to put their capital into the investments they want to do sooner rather than later, they do it at one time. So for example, on January 1st at 12:01 a.m., I logged on, I made my $7,500 contribution to my traditional IRA. And then on January 2nd, when the office opened back up, I got that converted over to the Roth. So now I got all my money in my Roth IRA. And I don't have to open separate IRAs. You don't have to maintain, many, many different IRAs to do this. You just have one traditional IRA, one Roth IRA. You make your contribution to the traditional, immediately convert it over to the Roth.
Gotcha. Okay.
So that's the backdoor contribution. Really, really important for people to understand. Now let's talk about a Roth conversion in the traditional sense of a Roth conversion. And what is a Roth conversion? Simply put, it's converting from pre-tax to Roth. The principles that I'm talking about here are going to apply the same when converting from a traditional IRA to a Roth IRA as they would if you're doing this in a solo 401k plan. With a solo 401k plan, you have a traditional side and a Roth side, and you actually have the capability of doing these Roth conversions within your solo 401k plan. And the way you do that is through what's called an in-plan conversion. So you're actually doing the conversion in the solo 401k plan. In a few moments, folks are going to understand why I'm talking about both IRAs and solo 401k plans. Because solo 401k plans for self-employed real estate investors can be a highly effective tool. It could be considered one of the most superior retirement planning tools specifically for real estate entrepreneurs and investors. Now, just focusing on Roth conversion here so we can understand this. Let's say I convert $100,000, which is pre-tax. I did not pay taxes on that money yet. I convert $100,000 to Roth. We call this a Roth conversion. It's as simple as saying Equity Trust or whoever your custodian is, please convert $100,000 from traditional to Roth. So that $100,000, because I haven't paid taxes yet, is added to my ordinary income. And then I pay taxes based on my marginal tax rate. So let's say I'm at the 24% marginal tax rate, tax bracket. I'm going to pay $24,000 in taxes to convert the $100,000 to Roth. Now, some people will look at that and say, ouch, that seems like a pretty big tax sting. But what you have to look at is the long-term tax-free compounding interest in the absence of taxation. And once we get to some case studies and examples, you'll start to see why that could potentially make sense for you. Now, a Roth conversion is not right for everyone, right? So I don't want folks to think that I need to go run out and convert all of my money from traditional to Roth. There are different strategies that can be discussed within this realm of Roth conversions. So a couple bullet points to make note of here. Number one, you can convert a portion or your entire traditional IRA. So maybe you have $500,000 in a traditional IRA. And if you convert 500,000 from traditional to Roth, that's going to be a rather large tax consequence, right? That's going to be 500,000 added to your ordinary income. And so that could be a significant tax burden. So what some people will do is they'll convert in stages, we call it, or converting in phases, where maybe you're converting over multiple years so that you could spread your tax burden out over multiple years. You'll see here you can convert multiple times throughout the year. So what some folks will do, for example, right now, we're still in the month of March. We're still in the early innings, if you will, of 2026. And maybe you don't know what your tax situation is going to look like by the end of the year. So what you might consider is converting some now, and then at the end of the year, when you have a better idea of where your tax bracket is going to end up, then you could just convert a little bit more money over at the end of the year. Another thing that I like to talk about here, Brady, is what I call converting deal specific. Converting deal specific. I would encourage everyone on the call to write that down. Convert deal specific. Let me give you a couple quick examples. I have a client right now that's investing in a privately held startup. It's not real estate related, but you could ultimately consider it relevant to a real estate conversation. So this individual is investing in a startup company, and he feels pretty strongly in 3 to 5 years, there'll be a sale and exit, and he'll receive anywhere between a 4 to 5x multiple. So 4 to 5 times his money that he's investing. He's investing $80,000. So what he's doing is he's converting $80,000 from his traditional IRA to his Roth IRA. He'll pay taxes on the $80,000. He'll make the investment in the privately held company with the $80,000. And all of the returns, let's assume that it works out well. And it may not, right? There's risk, of course, investing in private deals like this. But if it works out well, then that 4 to 5x multiple, that profit will go back into his Roth and he'll pay 0% tax. And by then, he'll be in his retirement years to where he could draw down on that Roth 100% tax-free, or he just continues to rinse, repeat, reload, reinvest into another opportunity. Another example, which is a real estate-oriented transaction, I have a client that is very good at finding self-storage investment opportunities. He's good at finding motivated sellers, landlords that own self-storage buildings, and they're not doing a great job with keeping up with the occupancy and the overall management of the building. And these are anywhere between like 50 to 100 to 150 locker buildings. Okay, these aren't your megaplexes that you see that are very corporate. These are your mom and pop type deals. And so he's good at finding these opportunities. He finds a self-storage building, and instead of executing on acquiring the building, he puts an option on the property. So he works with the seller and he puts an option on the deal. And that option, the option fee was $2,000. So he gave the seller a $2,000 option fee. He tied up the property on an option. He has the right to acquire that building, that self-storage building. He has a right to acquire it at a future date at a predetermined price. The option contract also is assignable, meaning he can sell it to an investor buyer. He only needed $2,000. He converted $2,000 from his traditional to his Roth, paid taxes on $2,000. He ended up selling that option to an investor buyer that then closed with the seller, and he made a $20,000 fee. So that $20,000 in profit went back into his Roth IRA. And that was a no-brainer in that case. Would he rather pay taxes on $2,000 or $22,000, right? So it made a lot of sense for him to convert that $2,000 and make that investment. So you can apply that to, just about any type of transaction that you might consider doing. Again, converting deal specific. And you don't have to convert your entire traditional IRA to Roth. You can convert just a portion of it. Okay, moving on here. Understanding the tax brackets with respect to Roth conversions is really important. Understanding the tax strategy of this, overall, very important. Congress gave us the deal of the century with the One Big Beautiful Bill on July 4th of 2025. Now, this is not a political conversation. This is not me advocating this bill for or against. This is me purely explaining to you what the One Big Beautiful Bill did with respect to the tax brackets that directly impact the opportunity to convert from a traditional to a Roth. And what you'll see here demonstrated is why I say Congress gave us the deal of the century to convert from traditional to Roth, to pay taxes once so we never have to pay taxes the rest of our life, nor do our children or grandchildren have to pay taxes on that money. So let's walk you through a scenario. Let's say we have a $200,000 wage earner and they convert $100,000 from traditional to Roth. Under the old tax brackets, that you see on the left-hand side of the screen, a $100,000 conversion from traditional to Roth, whether that's traditional IRA to Roth IRA or within a solo 401k plan, would put this individual in this tax bracket, the 33% tax bracket. So they would pay $33,000 in taxes to convert that $100,000 from traditional to Roth. What the One Big Beautiful Bill did is it made the, call it, more favorable tax brackets permanent. If it wasn't for the One Big Beautiful Bill, we would have gone back to the pre-2018 tax brackets. So those more favorable tax brackets that you see on the right-hand side of the screen, those were supposed to sunset on December 31st of 2025. The One Big Beautiful Bill made those permanent. So now let's look at this through the lens of a conversion using the same scenario. $200,000 wage earner converting $100,000. That's going to put them at the 24% tax bracket. So instead of paying $33,000 in taxes, they pay $24,000 in taxes. That's a $9,000 tax savings comparatively. Now, will these tax brackets eventually revert? Well, right now they're permanent, but anything could happen under an act of Congress. And so that's why we encourage folks to talk to their tax consultants, their CPAs, and have conversations about looking at how they can pay taxes now and never pay taxes again. So that's the Roth conversion. We talked about contributions to traditional and Roth IRAs, and we talked about Roth conversions. So what about funding your account through other retirement accounts? So first, let's look at if you have a 401k, a 403b, a TSP, a 457b governmental deferred compensation plan. These are employer plans. The natural progression is when you leave that employer, you can then initiate what we call a direct rollover into a self-directed IRA. You could roll over the entire amount or you could roll over just a portion of it. That's entirely up to you. Now, generally, you do have to leave that employer, meaning if you're still working for a company and you're under the age of 59 and a half, unfortunately, it's pretty seldom that you can roll any money out into a self-directed IRA. Unfortunately, you're going to be locked into that employer's 401k and locked into the investment choices, which are typically just mutual funds, until you actually meet a qualifying event, which means you've left that company. If you have Roth money in a 401k, 403b, TSP, 457, so that's after-tax Roth money, that money can be rolled over into a Roth IRA, or it can be rolled over into the Roth component of the solo 401k plan. For some people, if they qualify for a solo 401k plan, they're going to want to roll that Roth money into the Roth component of the solo 401k plan because a Roth IRA can't get rolled over into a solo 401k plan. All right, then for those of you that have IRAs, traditional IRA, SEP IRA, rollover IRA, simple IRA, providing that it's seasoned for 2 years, you can simply establish a self-directed traditional IRA and then initiate what we call a trustee to trustee transfer. That is simply put, just transferring money from one bank account to another. There are no taxes or penalties. Notice on all these slides, I'm listing in green there. No tax, no penalty, as long as you move your money directly from one financial institution to another. As long as that money doesn't pass through your own bank accounts personally, there are no taxes, there are no penalties. And when you begin investing in real estate, as you'll see in a few moments here, you're not distributing from the account, you're not borrowing against the account, you're actually making investments. No taxes or penalties there either. All right, lastly, if you have a Roth IRA, you can simply transfer Roth to Roth. You would liquidate your stocks, mutual funds, no taxes there, and transfer cash over into the self-directed Roth IRA so that you have cash ready to go in order to invest in your next property acquisition. HSA health savings account. So turning the page on the IRAs, and I'll be quick on the HSAs because we want to get to the solo 401k plans, as well as not everyone qualifies for an HSA. With health savings accounts, interestingly, you can self-direct an HSA into real estate transactions. For example, my HSA owns a percentage of a 16.5-acre property in a city called Madison, Ohio. My HSA also has a percentage of private money loans that I make to real estate investors for house flipping. Your HSA can be self-directed into all sorts of alternative investments. HSAs have what we call triple the tax benefits. You get a deduction for the contribution, you get tax-free growth, and you get tax-free distributions, providing that you use it for medical-related expenses. The contribution limits I have on the screen for you, just so you know, in 2025, you can contribute up until April 15th. So just like an IRA, you still have the opportunity to contribute to an HSA for 2025. You have until April 15th, as long as you had a high deductible health insurance plan. That is the prerequisite or pre-qualifications to contribute to an HSA. You have to have a high deductible health insurance plan. And if you're not sure, just call your health insurance provider and ask them, does this health insurance qualify for an HSA? But you'll notice there the contribution limits. For example, in 2026, let's say I'm under the age of 55 and I'm married and both of us are on the same health insurance policy. Well, guess what? I can contribute $8,750 and I get an $8,750 tax deduction. And then instead of distributing from the HSA to pay for my medical expenses, because that is what most people do. Most people contribute and then they use all of the money throughout the year for their healthcare related expenses. Well, instead of doing that, you can look at utilizing a strategy, a tax strategy that a lot of people don't know about or talk about, called medical bill stacking. So I'd encourage folks to write that down, medical bill stacking. Here's the economics of it. In HSA, you get a deduction going in, you get tax-free growth, and you get tax-free distributions. So for example, last year on one private money loan within my HSA, I had $1,100 in interest income flow into my HSA, $1,100 in profit. I paid 0% tax. Had I done that deal, not in my HSA, but outside of my HSA, I would have paid anywhere between $275 to $300 in taxes. Instead, I have $275 to $300 in tax savings. Now, I know that doesn't seem like a lot, but that's just one transaction. Compound that over many private money loans, many real estate transactions, and that becomes really significant over many years. That's why I always say compounding interest in the absence of taxation. So here's the strategy that you can consider. Instead of taking money out of your HSA, keep the money in there, keep it growing tax-free. When you have a medical expense that comes up, you put that medical expense, you put that bill in an electronic archive, like a Google Drive. Share that with your spouse. You pay for it out of pocket. You don't get a deduction for it. You don't take the money out of the HSA. You just pay for it out of pocket and you store away that medical bill. Later on in your life, whenever you decide to, without any time limit, you can distribute from the HSA and reimburse yourself for that previous year medical expense. This is what I call medical bill stacking. IRS Notice 2004-50. It's out of all the IRS notices that I read, this is one of my most favorite IRS notices. IRS Notice 2004-50. 2004-50 says that without any time limit, meaning it could be 5 years from now, it could be 30 years from now, it doesn't matter. The IRS is saying without any time limit, I can do what I'm telling you, which is reimburse myself for previous year's medical expenses. There are two conditions that I have to meet. Number one, I can't double dip. I couldn't have gotten a tax deduction and then try to reimburse myself. IRS obviously isn't going to allow us to do that. Number two, I had to have had an HSA funded at the time of incurring that medical expense. I meet those two conditions, I can utilize this strategy. Now, lastly, if you have an existing HSA, you don't have to change your healthcare policy. You don't have to change your employer like a 401k. You can just simply do a trustee to trustee transfer. You open up a self-directed HSA, and then you initiate a transfer, whether it's a portion or all of it, into an equity trust HSA. So you break that HSA free of really not being able to do anything, and you move it into a self-directed HSA that allows you to invest in real estate and other real estate assets. Okay, solo 401k plan, and then we'll jump into case studies and examples, and then Q&A. The solo 401k plan, I mentioned it earlier. This is, I consider to be the most superior retirement plan for real estate entrepreneurs and investors. It could go beyond real estate folks, by the way. Like I have folks that work in the medical professional where they're an independent contractor. I have management consultants, speakers, trainers, people that work in the gig economy. They have a lot of 1099 income. This plan can be really powerful for them as well. But for real estate investors and entrepreneurs, there is so much tax strategy planning opportunity with this particular account. So the solo 401k plan, this gives you a diagram of what it looks like. You establish a solo 401k plan, and within that solo 401k plan, you have a traditional bucket, a pre-tax bucket, and then you have a Roth bucket. And when you contribute every year from your self-employment taxable income, those contributions can go in pre-tax and you get a tax deduction. They can go in after tax into Roth, no tax deduction, but tax-free growth, or you could do both. So I have some clients that want a portion to go in pre-tax and get a deduction, and then they want a portion to go in after-tax Roth. So now they have tax-deferred growth and they have tax-free growth. So they're getting some tax deductions now that they may feel necessary to achieve, and then they have tax-free growth occurring in the Roth account. And then you'll notice here, Brady, that you can do what's called an in-plan Roth conversion. So you can convert from the traditional side to the Roth side. Now, with respect to Roth conversions, here's something that I want to mention to everybody. I didn't mention on the slide earlier purposely. For those out there that meet real estate professional status, all right, and we're not going to go into a whole webinar on real estate professional status. Those of you that meet that status know what I'm talking about. If you meet real estate professional status or your spouse achieves the real estate professional status for you, guess what? Your passive activity losses offset what? Your active income. So you can team up with your tax consultant, and if you meet the real estate professional status, you could potentially put yourself in a situation, if you already have a lot of passive income loss activity, you could potentially wipe out a lot of your active income and put yourself in a position where you can convert larger sums of money from traditional to Roth without large tax consequences. And then what? All of your growth in that Roth is tax-free for the rest of your life. You leave it to your children or grandchildren. They continue to grow it tax-free for 10 years and then distribute it 100% tax-free. So that's the diagram of the solo 401k plan. Let me talk about the three primary benefits that you want to be considering as you're examining, is a solo 401k plan potentially a good fit for you? Number one, the ability to make larger contributions, far exceeding an IRA contribution. Can you contribute to your IRA and a solo 401k plan? The answer is yes. The contribution limits you see there on your screen, $72,000 when you're under 50, And then when you're 50 and over, there's a catch-up contribution that you can make of 8,000 that gets you to 80,000. Number two, this entire contribution that I'm referencing here, 72,000 or 80,000, that can go directly into the Roth component. Now, you have to take some steps to get everything into the Roth component. You'll learn about that. But ultimately, you can have 100% of that money in the Roth component of your solo 401k plan. This is what we call the mega backdoor contribution. And to give you a quick case study example of this, I'm working with a real estate agent. Her name is Kelly. Kelly is 51 years old. Kelly is trying to catch up, saving for retirement. So she spent a lot of years without a retirement account because for most of her years, she was self-employed and she thought that retirement accounts didn't apply to her. She then started learning about self-directed IRAs and eventually solo 401k plans. So here's what Kelly is doing this year. Again, she's 51 years old. She's going to have a full $80,000 contribution go into her solo 401k plan. She is, as a realtor, going to declare around $100,000 in self-employment taxable income. About $100,000 in self-employment taxable income is what she's projecting. That's going to get her enough to be able to get $80,000 into the solo 401k plan. And that's all going to end up in the Roth component of the solo 401k plan. She plans on doing that for 4 to 5 years. So by the time she's the age of 50 to 56 years old, right, she's going to have approximately over $400,000 in the Roth component of her solo 401k plan. And then she's going to continue to invest in real estate. That takes me to the last bullet point. Part of Kelly's strategy is investing in debt-financed real estate deals. She's planning on buying rental properties with what we call a non-recourse loan. When your IRA or 401k borrows money, your IRA or 401k has to borrow on what we call a non-recourse loan. And that's her strategy. With a solo 401k plan, her solo 401k plan will be exempt from a little known tax called unrelated debt financed income tax. See, with an IRA, if you borrow money to acquire property, what happens is you have to perform a calculation. You have to look at the percentage of the property that's leveraged, and then you have to pay taxes on that percentage of the net gains. So for example, with an IRA, if I buy a property for $100,000 and borrow $50,000, I'm going to have to pay unrelated debt financed income tax on 50% of the net gains. Now, I do get to take advantage of writing off depreciation in that case, my operating expenses, right, my interest, just like a rental property outside of your IRA. But I am exposed to that unrelated debt financed income tax. Plenty of people use their IRAs to do debt finance deals and pay the unrelated debt financed income tax. But what if an individual can be put in a position to do it better? And that's what a solo 401k plan can achieve for someone. They can do debt finance real estate deals and they are exempt from unrelated debt financed income tax. And that's because Internal Revenue Code 514C9A carves out an exemption for unrelated debt financed income tax. So what you start to learn here, Brady, is you have the law and then you have exclusions and exemptions to those laws. And when you read and you understand this and you work with professionals, you start to gain exposure to the nuanced strategies that the top 1% of wealthy people have been using for a lot of years, but the traditional Wall Street type tax accountants and advisors don't tell people about this because they either don't know or they don't want to spend the time to do it. And so this is a really powerful strategy for real estate investors to consider because they can save on taxes, they can do more deals by using leverage, and they can build their portfolio faster, ultimately helping them get to their financial goals in a shorter period of time. So that's a big takeaway. Now, this slide here, I'm not going to go through every finite detail. I just want to put up on the screen here, for a solo 401k plan, you can still contribute for 2025. Now, the window is shutting very quick. By April 15th, you're going to lose some opportunities here. But you'll see the contribution limits for 2025 and 2026. Think of a solo 401k plan very similar to a 401k that you would have with like an employer that you work for. You have an employee deferral contribution. You have something called a profit sharing contribution. and then you have something called an employee non-deductible contribution. So you'll see those contribution limits there. As far as deadlines are concerned, if you're a sole proprietorship, you're a self-employed individual, maybe you're a real estate agent, maybe you flip houses and you have self-employment taxable income, you're not an S corporation, you're a sole proprietor or an LLC taxed as a sole proprietorship. Guess what? You can still contribute to a solo 401k plan up until April 15th, and you can get the full $70,000 contribution in there. And if you're 50 and over, there's an extra $7,500 catch-up contribution. If you go past April 15th, unfortunately, you're only going to be able to do what's called a profit sharing contribution, which is up to 20% of your net business income as a self-employed person. You can still get some contributions in there and get some tax deductions. So for those of you out there that are looking for tax deduction opportunities for 2025 as a self-employed person, you still have plenty of opportunity to do that within a solo 401k plan for tax year 2025. For those that are S corporations out there, you can't do an employee contribution, but you can still do a profit sharing contribution up to 25% of your W-2 from 2025. That would be your W-2 from your S corporation. So for example, I have a client, his name is Eli. He had a W-2 from his S corp of $70,000 in 2025. He's doing a full 25% profit sharing contribution into the solo 401k plan. 25% of 70,000 is $17,500. So he's going to get a $17,500 tax deduction for 2025, and then those funds will grow tax deferred in his solo 401k plan. In 2026, he's already setting himself up to make that full $72,000 contribution into the solo 401k plan. And part of Eli's motivation to use a solo 401k plan is his investment strategy is investing as an LP, a limited partner, in real estate syndications. So he looks for multifamily real estate opportunities, investing with experienced and well vetted multifamily operators, and he invests as an LP in those opportunities. So he's using his solo 401k plan to invest in those types of opportunities because of that exemption from unrelated debt financed income tax that I talked about. Okay, and then lastly, to finish up on solo 401k plans, if you have existing retirement monies, you can roll over those retirement accounts into a solo 401k plan. Your 401ks, your Roth 401ks, your SEP IRAs, your simple IRAs. The only account that you can't roll into a solo 401k plan is a Roth IRA. Once a Roth IRA, always a Roth IRA, as I like to say. Okay, now let's transition to, because this is where I think a lot of folks are going to be able to capture a lot of understanding of how all this works. So we went through all of the plans, contribution limits, Roth conversions. So now you have a better idea of how to set up accounts, how to contribute, how to fund those accounts. Setting up the accounts and funding the accounts is a great first step. But if you set up accounts and fund accounts and you don't do anything with the money, it's not going to do you or anyone any good. So you want to be strategic and you want to be active in investing that money. So investing in rental properties, flips, and private money lending. There are 4 methods to finance real estate transactions with these self-directed accounts. First is as a cash buyer. That is, your IRA or solo 401k plan or HSA has enough cash in it on its own to go out and acquire a property. Your account pays for all the expenses, and then all profits go back into your account. Who's making all the decisions? Who's calling all the shots? You are, as the account owner. Equity Trust, for example, as a custodian, we're not making the decisions on where you invest and how you invest. You're making all of those decisions. So think of this as another bank account that you're pulling from to make investments. But guess what? It's a tax-privileged bank account. It's a tax-deferred or tax-free Roth bank account. So the second you see there is partnering with certain family members. We refer to these individuals as disqualified persons. Disqualified persons. Within Internal Revenue Code 4975, there are outlined disqualified persons and transactions that can occur between a disqualified person in your IRA that could trigger what we call a prohibited transaction. And if you trigger a prohibited transaction, then your IRA becomes distributed January 1 in the year in which the transaction occurred. When you're partnering your IRA funds with a spouse's IRA, or your IRA funds with your non-IRA funds, or your IRA funds with a parent's IRA funds, you have to make sure that you follow what we call the pro rata rules, or in proportion to. For example, I have a client, his name is John, and John and his wife Teresa acquired a property for $75,000. 3 years later, they sold that property for $210,000. Through the rental income over the 3 years and the appreciation, the profits on the sale, they made about $146,000 tax-free in their Roth IRAs. John's Roth IRA funded 82% of the deal, and his wife Teresa's Roth IRA funded 18% of the deal. So with an 82%, 18% split, all of the rental income was split 82-18, and then all of the expenses, so taxes, insurance, repairs, improvements, all expenses were paid out 82-18. So if you're going to partner with what we call disqualified persons pursuant to 4975 of the Internal Revenue Code, you really got to be careful, and you really got to make sure that you're following those pro rata rules. So that's the example of John and Teresa partnering their Roth IRAs together. They made over $140,000. None of that income had to be reported on a Schedule E. None of that income was capital gains taxable. It was all tax-free in their Roth IRA. The third you see there is partnering with what we call a non-disqualified person, potentially utilizing a joint venture type structure. And I'll show you an example of that in just a moment, where one could potentially acquire a property, partner with a non-disqualified person, and then receive a larger percentage of the net profits into their Roth IRA, their Roth Solo 401k plan, or HSA. And then lastly, you see borrowing money to acquire real estate using what we call a non-recourse loan. When your IRA or 401k borrows money, you can't sign a personal guarantee. So most lenders, banks, other institutions, when they're lending money, they require the borrower to sign a personal guarantee. With an IRA or 401k or these other tax-free accounts, under 4975 of the Internal Revenue Code, more specifically 4975C1B of the Internal Revenue Code, if you sign a personal guarantee, you would have effectively engaged in a prohibited transaction. So you have to find a non-recourse lender, and there are plenty of non-recourse lenders out there that will loan to IRAs and 401ks. One name, which in full disclosure is affiliated with Equity Trust, is a lender called IRA Power Loans, irapowerloans.com. There's also First Western Federal Savings, North American Savings Bank. You can do an internet search and find a whole host of lenders that will loan to IRAs and other retirement accounts. So let's go through case studies and examples. So here we have Kevin and Cynthia, and they started in about 2011 and 12. They had about 117,000 in their 401ks that they rolled over into traditional IRAs and then converted to Roth and began investing in real estate. And they've done well over 40 real estate transactions now. They've grown their portfolios, their Roth IRA portfolios, to a total of over $2 million in property value, and they're generating over $200,000 in net tax-free cash flow on an annual basis. They did something we call convert in stages. So in 2011, Kevin rolled over his money, converted it to Roth. In 2012, his wife Cynthia rolled over her money, converted it to Roth. Started with about 117,000. Now, it took a few years for them to get the flywheel building, right? Some people are starting with smaller balances, right? And so the idea is you got to get momentum with that flywheel. But once you get to critical mass, then you can start doing more transactions and you have more freedom and flexibility, obviously. So as they say, always better to pay taxes on the seed than the much larger crop. So here's two transactions that they did where they made between 16 to 20% cash on cash return. Both of these properties they bought from motivated off-market sellers. They acquired the properties. They paid for renovations, improvements. They forced appreciation through the renovations and improvements. And their IRAs, of course, were paying for those renovations and improvements because, as we talked about, the IRA buys, the IRA is responsible for all fix-up and repairs, and then all profits go back into the Roth IRA. These properties are owned free and clear and have always been bought free and clear with their Roth IRAs. So they acquired these properties, fixed them up, and then sold them on owner financing. They buy and sell real estate in their Roth IRAs. They sell on owner financing or lease option to purchase. They also have some long-term buy and hold rental properties. The lease option to purchase and or owner financing deals put them in a position where the tenant buyers will qualify for financing in 2 to 3 years, and then they will pay off the owner finance note, which is profit back into their Roth IRAs. So they made about $70,000 in profit, and along the way, a 16 to 20% cash on cash return. All of the income from the sale, all of the income, rental income, is all flowing back into the Roth IRAs tax free. Now, Roth IRA number one has 7 rental properties generating $7,400 in monthly net tax-free cash flow. So that's after all expenses. And then Roth IRA number 2, Cynthia's Roth IRA, is generating $6,000 in monthly net tax-free cash flow. So when we look at it on a consolidated basis, they have $162,000 in annual net tax-free cash flow. And then as they have cash that flows back into the Roth IRA, they don't just have that Roth money sit there and not do anything. They buy owner finance notes, they buy residential owner occupied loans, and they also lend money secured by real estate for individuals to flip houses. They make between an 8 to 12% return pretty consistently on their private money loans. So when it's all said and done on an annual basis, they're at about $52,000 in interest income. So all the rental income, all the interest income flows back into the Roth IRA. There's no filing of Schedule E's or B's or any tax returns because their Roth IRAs are tax-free. So they don't have to report that income. It's all tax-free in their Roth IRA. If they distribute money, they don't pay any taxes either because they're now of the age of 59 and a half and older. Now, their goal, interestingly, Brady, is not to use the money themselves, but their goal is to leave their Roth IRAs to their children, or maybe even leave their Roth IRAs to their grandchildren, skip a generation. Because what you'll learn about Roth IRAs, I mentioned it earlier, legacy and estate planning. With Roth IRAs, you can leave those accounts to your children or grandchildren. They pay 0% tax, unlike a pre-tax account where your heirs have to pay taxes when they distribute the money. Not when they inherit it, but when they distribute the money, they have to pay taxes. But with a Roth IRA, they don't have to pay taxes. They can continue to use that Roth IRA for 10 years, and then when they distribute, they pay 0% tax.
That's beautiful. So I can see how that would compound.
Yeah, exactly. So it's almost like you have an extra 10 years. You're in the grave, and you have an extra 10 years of tax-free growth for your heirs. And that is part of the reason why we find that folks are strategically converting from traditional to Roth, especially right now when we're governed under some of the lowest tax rates that we've ever been in the country. All right, so this structure is important, I think, for folks to understand. It's what we call a real estate checkbook LLC. So when owning real estate from an efficiency perspective and asset protection perspective, we find that some investors prefer to own real estate when they buy with their IRA or solo 401k plan in an LLC. So this is what the model looks like. You establish your self-directed IRA. You form an LLC. The LLC is formed. Your IRA becomes the 100% member of the LLC. You're the manager of the LLC. You're in full control. You set up a bank account for that LLC. Most of our clients use a bank called Titan Bank. So you have a bank account for that LLC. You then have checkbook control. You acquire real estate. So let's say you buy a rental property. The rental property is owned by the LLC. The LLC is owned by your IRA. And you are in full control of all this. You're the manager of the LLC. You're the IRA account owner. Now, all of your rents flow into the LLC bank account, and all of the expenses go out of the LLC bank account. And Brady, this has worked really, really well, especially for folks that we work with that are also using the Rent Ready platform. So we have clients that set up this checkbook LLC IRA model. I'll show you an example in just a moment. And then they plug into the Rent Ready platform, and they can easily manage their rental properties. So they have rental properties outside of their self-directed accounts, and they utilize the platform that you guys have. And then they have their self-directed IRA deals in an LLC, in one of these real estate checkbook LLCs. And it's a very similar user experience there. So this is what we call the real estate checkbook LLC. Now, to build on that, what about partnering multiple accounts together? So this would be a multi-member LLC where maybe you have multiple money sources, like in this example, a traditional, a Roth, a spouse's IRA, some non-IRA funds in an LLC, and then that LLC has a bank account. The cash is transferred to the LLC bank account. You acquire real estate, and then all of your rents flow back into the LLC, all expenses paid from the LLC. And this makes things a lot more efficient and fluid. Because could you imagine partnering multiple accounts together and trying to split expenses and rents? That would get really complicated. And so that's why investors utilize this multi-member LLC model. Here's a real example, Brady. This is a property that I bought last year. I'm in Cleveland, Ohio. That's where our headquarters is located, has been since 1974. And I acquired this property. It's in a rural market called Madison. It's a 3-bedroom, 1-bath. It's being rehabbed as we speak. And when I acquired this property, 16 and a half acres, instead of partnering all of my accounts on the deed to the property, instead, I formed an LLC called a real estate checkbook LLC. I brought in the Roth side of my 401k at 74%, the traditional side of my 401k at 17%, my HSA at 5%, and my Roth IRA at 4%. So this is that number 2, partnering with disqualified persons. So I got to make sure I establish my percentages pro rata or in proportion to the capital that I invested. I had $205,000 for the purchase, and then I funded extra money in there for rehab. So I sent 4 wire transfers to the LLC bank account ahead of closing. I had a wire transfer come from the Roth side of my 401k. 17% of the amount came from the traditional side of my 401k. 5% came from my HSA, 4% from my Roth IRA. This LLC owns the property. I'm the manager. All expenses are paid out of the LLC bank account. And then eventually, when the property sells, all the profits will go back into the LLC. And at that point, the profits will flow back through the LLC back into each of my respective accounts pro rata. Now, I don't have to send the money back into the accounts. Maybe I rinse, repeat, reload, and do another deal. Maybe I buy a rental property with that LLC as my next transaction. So I have the freedom to do that. Now, at some point in the future, I need to get the money back into the self-directed accounts. So if I want to take a distribution for personal purposes, once I turn retirement age, I'm going to start harvesting from the account. Naturally, I would, at that point, make sure I distribute through the LLC back into my self-directed accounts. So that's an example of the checkbook LLC at work. Now, some more examples of partnering multiple accounts together. This house I bought in March of 2020 for $63,000 from a motivated landlord. They weren't doing a good job keeping up with the deferred maintenance and the tenants. And so I acquired the property for $63,000, partnering my Roth at 55, my traditional at 35, and then I had some non-IRA cash in at 10%. Over the 2 years, I call this a buy, rent, flip model. Over the 2 years, I made the repairs and improvements, increased the value of the property, got the property stabilized, tenanted, had 2 good tenants in the property. It was cash flowing, marketed the property, sold it for $115,000 2 years later. And you'll see there a 32% annualized return on investment. Along the way, all rents and all expenses just flowed 55, 35, and 10%. Another example of partnering, Gary and Jan and their daughter, Brittany. Their daughter, Brittany, working for their real estate business, had a Roth IRA as earliest as 15 years old. And they partnered their Roth IRAs together to do fix and flip transactions. This one here is in St. Louis, Missouri. Jan's Roth IRA funded 42%. Gary's Roth IRA funded 55%. And Brittany's Roth IRA funded 3%. So going forward, from the purchase of the property all the way through the renovations, they had from the earnest money deposit through closing, through renovations, everything was split 55, 42, 3%. Sold the property, made $164,000 profit. That $164,000 in profit was split up 55, 42, and 3%. So you see there, Brittany, her Roth IRA grew by over $4,500, nearly $5,000 in profit. Now, of course, we would love if we could just have all the profit go back to Brittany's Roth IRA. But remember, Brittany is a disqualified person with respect to her parents. So she doesn't have the luxury, and they don't have the luxury of just having all that money go into her Roth. Interestingly, Brittany went to law school, and she was able to distribute money from her Roth IRA tax-free to pay for some of her law school, Because remember, contributions to your Roth IRA, you can take out anytime tax and penalty free, even under the age of 59 and a half. She did have to leave the earnings or growth in there, but she was able to take some of the growth out and avoid the 10% penalty because there's an exception to the 10% premature withdrawal penalty for higher educational expenses. So that's when we get into Internal Revenue Code 72T. You have 72T, 10% early withdrawal penalty, but then you have exceptions to 72T. That could be distributing from contributions you made to the Roth. That could also be something called substantial equal periodic payment distributions from a traditional account. So that's for a whole nother time and a whole nother conversation. But I like to just pepper in there, Brady, that there are interesting exceptions to that 10% premature withdrawal penalty.
So, okay. John, for that one, for that last case study, would they be using one LLC to funnel the 3 different IRAs into, like you'd showed a couple slides back?
So they could do that. Now, on this particular transaction, they actually did it. They had a general contractor, so the expenses being paid out was pretty straightforward. And because it was a flip, it wasn't like they had a bunch of rental income. So they actually took title directly to the property, where the deed to the property had each of their IRAs listed with their own respective undivided interest percentages. But gotcha. We do find that other people prefer to form an LLC.
Okay, nice.
And then kind of rounding things out here, disqualified persons we just talked about. What about if you partnered with non-disqualified persons? So in this example, we have Doug and Ron, and Doug finds an opportunity for a fix and flip. This is a 3-bedroom, 1-bath in Dayton, Ohio. He only has about $13,000 and some change in his Roth IRA. He partners up with his investor friend, Ron. And you'll notice there that it was $105,000 for the purchase and rehab. Ron only had, or I should say Doug, only had about 10% for the deal. And then Ron had the other 90%. So Doug and Ron partnered together on the deal. It didn't have to be Ron's retirement money, but it just so happened to be his retirement money. They partnered together on the fix and flip deal. They made $68,000 in profit. They had a joint venture agreement, and in that joint venture agreement, they had spelled out that 50% of the net profit goes back to Doug's Roth, and then 50% of the net profit goes back to Ron. So Doug's Roth IRA makes $34,000 tax-free. He grows his Roth IRA from $13,000 and some change to over $47,000 tax-free. So the lesson to be learned there is, if you're going to partner with non-disqualified persons, potentially putting together a joint venture type transaction like this, you can potentially take a larger percentage of the profits. Now, one caveat to mention here before I move on, if you're going to do short-term flips like this, you do have to be aware that if you do too many of these flips, your IRA could be exposed to a special tax called unrelated business income tax. So that's why a lot of people in the industry follow the rule of thumb to not do more than 2 of these types of transactions over a 2 to 3 year period. So in other words, limit the fix and flips, and then look to do more passive investments in such as rental properties, private money loans, and other transactions that wouldn't trigger that unrelated business income tax. Or you just pay the tax and move on. All right, lastly, yeah, go ahead.
John, there's one question I think it's relevant to what you're talking about real quick. Are you actually working on the properties or managing them yourself, or is everything outsourced to contractors and a management company to meet IRS requirements for self-directed IRAs?
Yeah, the rule of thumb, that's a great question. I see Karen that popped up there. So the way it works is, the rule of thumb that's used in the industry is stick to the desk duties, stick to the administrative desk duties, and stay away from the physical sweat equity. And the reason why is because in the tax code, it says that, this is Internal Revenue Code 4975C1C. It says that if a disqualified person furnishes goods, services, or facilities between the plan and a disqualified person, it's a prohibited transaction. Now, services is not clearly defined. We don't have clear definition from tax court cases, revenue procedures, IRS notices, private letter rulings. There's some glimpses and some insight into this, but it's not clear enough. And so the rule of thumb that folks follow in the industry is stick to the desk duties and stay away from the physical sweat equity. Stay away from swinging the hammer to the nail, fixing the fluid master and flapper, like I say, painting the walls, changing light bulbs, things of that nature. So that answers that question. This one here, Elizabeth, she used her IRA. She set up an IRA, transferred it over, formed an LLC, and borrowed from a non-recourse lender. She used IRA Power Loans, who I mentioned before. She bought a duplex in Pennsylvania for $80,000. The loan amount is $56,000. Down payment is $24,000. LTV is 70%. The interest rate on the loan is 9.75%. These are non-recourse loans, so interest rates are going to be higher. And you'll see the monthly gross rents, the monthly payment, annual payment. Not to get lost in all of the numbers here, here's the bottom line on this transaction. It's an IRA that's borrowed money. It's 70% leveraged. So 70% of the net gains are subject to that unrelated debt financed income tax that we talked about. When it's all said and done, at a 10% tax rate, which is where that amount would fall into the brackets, she pays about $300 in taxes. So if she owned this deal free and clear, she would pay no taxes. But because she has debt, she has to pay this unrelated debt financed income tax. But you'll notice there that the cash flow is still really strong, and she's making a 28% cash on cash return on investment. So still makes sense to do the deal and pay the tax. Now, is she qualified for a solo 401k plan? Then she could potentially have done this in a solo 401k plan, and she wouldn't have to worry about paying that unrelated debt financed income tax. And then lastly, just some examples of private money loans secured by real estate. Here's a deal right outside of Cleveland, Ohio, in a city called Ashtabula, an $80,000 private money loan to a fix and flip investor. So this isn't myself lending money to myself. I can't do that, right? This is my Roth IRA loaning money to a house flipper, somebody who does this professionally. They have a construction company, they're licensed, bonded, this is what they do. So I loaned $80,000 and it was a 14% return, $5,600 in interest profit. That went back into my Roth IRA. I paid no tax. Here's another example. And this particular loan is to the same borrower as the previous loan. $193,000 loan. The interest profit was $28,506.10. This loan paid off at the end of last year. It was a 13-month deal. From purchase through renovation, sale, I received my principal and interest back 13 months, 14.77%. $28,506.10 in interest profit. Interest income is subject to ordinary income tax rates, but in my self-directed accounts, it's exempt from taxation. And so I saved $6,800 in taxes. 80% of the loan was funded with my Roth, 16% was funded with my traditional, and 4% was funded with my HSA. So here's another example of my HSA partnering in on a deal, my Roth partnering in on a deal, my traditional partnering in on a deal. And you'll see at the bottom of the screen the actual interest profit that flowed into each respective account. Just like we've been talking about when you're partnering with disqualified persons, you have to make sure that you follow those pro rata rules. So just in recapping conclusion here, and then happy to stay on as long as necessary to answer any other questions that folks have. We talked about buying real estate directly. We talked about lending money secured by real estate. If folks have an interest or inclination to invest in like real estate partnerships, obviously that is an opportunity as well with their self-directed accounts. We talked through the different self-directed accounts, the 4 tax favored accounts, traditional IRA, Roth IRA, solo 401k, HSA. Could you have all 4 accounts? Yes. Could you just take advantage of 1 out of the 4? Certainly you could do that. And so we've covered a lot of ground. What I didn't mention much of, you did ask me at the very beginning, Brady, and I mentioned a few of the points, but I think at this point it is important just to put this slide up so folks know a little bit about Equity Trust Company, but by no means is this a commercial for Equity Trust. This is an educational learning opportunity, but you can check out Equity Trust and see more details on our background and what we do and how we operate. I would invite folks, if they're interested, to reach out to us, and we're happy to answer any questions and provide any further information. We're not advisors, we're not tax consultants, but we can certainly give you education and information. And as mentioned earlier, there's a book out there as well. I wrote this book and launched it at the end of last year, so this is the freshest of all the literature that we have that's available in the market. It's called Wealth Beyond Wall Street. It's a field manual for self-directed investing, and that's on Amazon.com. And then lastly, if anyone is interested, I'll put this QR code up. If you want to schedule a one-on-one conversation with one of our senior IRA counselors, you can use the QR code. You can schedule a specific date and time. If you want to establish an account, they can help you with that. If you're not ready to establish an account, that's fine. Don't feel like there's any pressure. That's the one way we approach this business is it's a no pressure type situation because we don't advise or recommend on where to invest or how to invest. So it's a lot different experience than maybe what you've had with like somebody in the insurance business or a financial advisor. And I'm not saying they're high pressure, but I know some people sort of feel obligated to maybe invest with that person. In this case, Equity Trust is a private asset custodian. So you make the decision to move forward or not move forward, and whatever works for you, ultimately, we're in a position to try to best accommodate and support you. So let me stop there,
I love
Brady.
that.
Thank you for the time and happy to answer any
Yeah.
questions that are left over.
Man, this is super valuable. I'm like, my notepad is filling up with notes over here. I'm like, okay, there's some things I need to look at on my own accounts, reevaluate some things. So we got some really good questions in advance. I'm going to tackle a few of those. And then everybody keep putting your questions in the chat. I see Emil, Karen, Emil, Curtis, Alfredo. Some really good questions. So we will tackle those. I've seen them come in. So thank you. We'll try and keep these kind of short because we have a lot of questions to cover, but I don't want to limit you at the same time. First one, can a self-directed Roth IRA be used for a down payment on purchasing a rental property, or does it have to be used to cover the whole purchase?
It can absolutely be used as a down payment. The financing would need to be a non-recourse loan, but absolutely, just like that example with Elizabeth, she formed an LLC, she put about $24,000 down, got a $56,000 loan from IRA Power Loan. So answer is absolutely. And also buying on owner financing. So if there's opportunities to buy an owner financing or subject to, those opportunities would be available as well.
Awesome. Okay, that's nice. Yeah, super flexible. Let's see. There were a few questions on 401ks. I'll rattle a couple of them off because they might have the same answer. Is it possible to use a 401k while still employed at that employer? And then how do I take money out of a 401k and repay without penalty? I got the consensus that you basically can't use that 401k when it's tied up at your employer, correct?
That's right. In most instances, when you're under the age of 59 and a half and you're still working for that employer, you're not going to be able to roll money out. You have to leave that employer. There are narrow instances where you can take what's called an in-service withdrawal when you're prior to the age of 59 and a half. So you can reach out to your administrator and ask if you can take an in-service withdrawal. The only time I see it apply is number one, if you had 401k money from an old employer that you rolled into the new employer plan, that money you should be able to roll out anytime. If you don't have any of that money, it's all money that came from that employer. Every once in a while, you'll find that a 401k allows for what's called an in-service withdrawal while you're still working there, but you'd only be able to take out what the employer matched you if you meet certain conditions. So the only way to know is to just call your plan administrator and ask if you can take an in-service withdrawal. If anyone happens to be 59 and a half or older, the good news is most plans, once you turn 59 and a half or older, that's the qualified retirement age in the United States. So most plans will actually allow you to roll money out while you're still working there and unlock that money and move it over into a self-directed IRA or solo 401k plan. And then the other question that you asked there, Brady, is accessing money from the 401k. If someone wants to borrow against their 401k, generally you can do that up to $50,000, not to exceed 50% of the market value of the 401k. That also is for a solo 401k, just like I talked about earlier. But when you borrow against the 401k, remember, you're taking the money out of the 401k. You can't take that money and then just put it into an IRA or a tax sheltered entity. That being said, sometimes borrowing against the 401k to, let's say, do like a BRRRR deal, use it as a down payment and then refinance and pay back the 401k. To me, that makes logical sense. I just would caution people because there are statistics out there that argue that when folks borrow against their 401k, there's a high propensity of default. And if you default on that 401k loan, you don't pay it back, you have pretty stiff tax consequences and penalties when you're under 59 and a half.
Interesting. Okay. Got a few more questions. Let's see. I'll go maybe one or two more on 401ks just so we can get the 401k ones out of the way. Not out of they're great questions. Just want to lump them together. How can I use my 401k? Let's see. Oh, sorry. Here we go. Do retirement funds require the property to be a primary home? How do we tap into other resources? No.
Yeah, so there with respect to the prohibited transaction rules, when your IRA makes an investment, you cannot receive any personal benefit, and that's directly from the tax code. So personal benefit would be, for example, you buy a property with your IRA and then you live in it personally. Or if it was like, let's say, a vacation rental and you stayed there a few days out of the year, that would be a personal benefit in a prohibited transaction. And from a tax efficiency perspective, because these accounts are so powerful, you wouldn't want to use the IRA or solo 401k plan or HSA to buy like a primary residence. You would want to be buying properties for investment purposes only.
Okay, that makes sense. Here's one I can answer real quick. How do tenants pay rent for IRA owned properties? Can I use tools like RentReady? Yes, absolutely, you can. Let's see. Can I put my company owned rental property into a retirement account? Can I use its equity in a self directed way?
Are they referring to an existing property that they own now?
Company owned rental property. It sounds like yes, like they own a business or they're a landlord investor with an LLC who owns a property. Yeah.
Yep. Okay. So you got an LLC. The LLC owns a property. Unfortunately, due to the prohibited transaction rules, the IRS would disallow if you tried to convey that property to a tax sheltered retirement account or even sold it at fair market value. So the idea is you would want to look at these strategies as strategies for new properties, new investments that you're going to do going forward.
Okay, that makes perfect sense. Let's see. This one's a little bit open-ended, and then I think I'll jump to some of the live questions. What does purchasing real estate with a Roth IRA look like? There were a couple other questions along the lines of like, are there any hidden fees that I could expect, or am I going to be losing money that I might not know of if I pull out Roth money?
When investing the Roth IRA or traditional IRA or solo 401k, a good way to think about it is it's just like buying a stock or a mutual fund, which most people are familiar with. My IRA or solo 401k plan buys shares of a publicly traded stock. So cash leaves that account, buys the shares of the stock. In exchange for the cash are publicly traded shares. I have dividend income that flows in. I sell that stock. I have capital gains that flows back into that account. When I buy real estate, it's the same exact concept. Whether I buy real estate through that real estate checkbook LLC or I buy real estate directly, it's the same concept. Cash leaves the account. In return for that cash is an asset. That could be a deed to a property. That could be a mortgage note or deed of trust. That could be any type of investment that isn't considered disallowed in the eyes of the IRS. And so that's a good way to think about it. There's no taxes or penalties. You're simply making an investment from the self-directed account.
Okay, that makes sense. We got one more, and then I promise I'll jump to these live questions. Keep them coming. You guys have really great questions. I'm seeing them in the chat. I'm not ignoring you. Can you speak to LLC structure at all? So we had someone ask, if I'm an active operator, what's the cleanest structure to avoid self-dealing or prohibited transactions? And another similar question, they had said, I have individual LLCs per property. What's the best holding company structure?
Yeah, so a good way to think about it. Great question, because a lot of my clients, including myself, own rental properties outside of our tax-free accounts and then also do deals inside of our tax-free accounts. And you want to treat those, think, as two separate businesses. So your rental properties outside of your tax-free accounts, maybe you do have a separate LLC for every transaction, maybe you have a holding company, and that's all fine. You're going to want to work with your asset protection attorney, your tax consultants, and manage all of that. Your self-directed deals are going to be separate. And so if you're going to buy a rental property, you're probably going to form a new LLC. Okay, you could buy the property directly with the self-directed IRA or solo 401k plan, but a lot of people prefer that LLC structure. So you'd form a new LLC. You'd have your IRA or solo 401k plan or HSA be the owner of that LLC, and then you would manage that separately, separate from what you're doing over here. Maybe you're partnering multiple accounts together. That's that multi-member LLC that we talked about. What you wouldn't want to do is take your self-directed account LLC and try to roll that up, if you will, under your Wyoming holding company or something of that nature. That would create prohibited
Ah,
transaction issues. So just make sure you treat those separately.
okay. That makes sense. That makes sense. Okay, let's tackle some of the live questions we have. One person had asked for the link on the QR code. I'll put that through the chat right now if you guys want to book a call, John's team. So that's in the chat. Okay, let me scroll up here. Derek said, "Holy smokes, that was awesome! High five, gents." I know it's a lot of information. It's good. I'm having to scroll way up. Let's see. Okay, Emil or Emily, are the rules of disqualified persons or actives the same for Roth IRA and solo 401k?
They are. 4975 of the Internal Revenue Code is going to apply to IRAs, Roth IRAs, traditional IRAs, SEP IRAs, solo 401k plans, HSAs, everything. The only nuance different are the consequences. Here's what's interesting. An IRA, Roth, traditional, HSA included, okay? If you do a prohibited transaction, then the entire account becomes distributed January 1 in the year in which that transaction occurred. Which, by the way, those cases are few and far between. We don't see that a lot. But every once in a while, someone is not educated, they don't take the time, they don't work with the right professionals, and they make a mistake, okay? So that's how it works with an IRA or HSA. Some people will actually purposely have separate IRA accounts so that if they do make a mistake, they don't impact their other IRAs. Now, a solo 401k plan has less severe consequences. With a solo 401k plan, what happens is you have a 15% penalty on the amount engaged in the prohibited transaction until you correct it. It compounds year over year until you correct it. But it's not a situation where you lose the entire status of the solo 401k plan. So that is an advantage. You can consider it in a solo 401k plan. The other interesting aspect of a solo 401k plan, I mentioned earlier about creditor and bankruptcy protection. So there's sort of two levels. There's creditor protection, and then you get into bankruptcy, and that becomes a whole nother presentation. But here's what I'll tell you that I think is important for people to know. With an IRA, you have up to about 1.7 million in bankruptcy protection. So if your IRA exceeds 1.7 million in a bankruptcy, they can come after the rest of it. But up to 1.7, you're protected. And
That's
that was
great.
because of a legislation that occurred in 2005. There was a bankruptcy protection bill that was passed, and that granted us that capability, and it adjusts for inflation. A solo 401k plan actually has unlimited bankruptcy protection. So there are some nuanced advantages of a solo 401k plan in comparison to an IRA, but don't look at it as a competition. Plenty of people have IRAs and solo 401k plans, and just understand some of the nuanced differences between the two.
Interesting. So here's a good one. Ola, I think it asked this twice. Is changing an employer the only way to transfer from traditional 401k to a Roth 401k? I know you had mentioned you can roll over or transfer like some of the contributions from an employer.
Well, that's a good question, Ola. Most likely, your plan as it is now, you might not be able to roll the money out and self-direct into, real estate and different private deals. So you might not be able to do that. They might tell you, no, you got to keep it there. However, if you're looking at this more from a tax strategy perspective to set yourself up for when you do leave that employer, you might be able to do an in-plan conversion in that 401k as it is, meaning you could start converting from the traditional side to the Roth side and do that until you retire. And then maybe when you retire or leave that employer, then you have a lot of money in the Roth that you can roll over into a Roth IRA or Roth solo 401k plan and start doing some real estate deals from there.
Okay, that's good. Thanks for asking that, Ola. Let's see. Okay, here's a good one. Alfredo, does the order of establishing a Roth and an LLC matter? If I've already set up my LLC, can I now set up my Roth as the owner?
You can, you can't. So when I hear someone say they set up an LLC first, in my mind, I'm thinking they set up an LLC, it's in their name, they have an operating agreement, it's in their name. It's not going to work. What you're going to need to do is set up an LLC specifically for your IRA. The operating agreement needs to have specific language that references the prohibited transaction rules. We do form LLCs specifically for people holding real estate. We provide to you from our outside counsel a specially crafted LLC operating agreement that has all of the nuanced language with respect to prohibited transaction rules. It references that you as the manager can't take compensation, because if you did, it would be a prohibited transaction. So there are some compliance things that you got to work through there. But the order of operations, great question, by the way. Order of operations would be open up your self-directed IRA. Step 2, file and form your LLC. Step 3, you'll wire transfer money from your IRA to the LLC. And of course, before all that, you would transfer money from your existing IRA custodian to the equity trust custodian. You got to do that first. And then once you're there, you got the LLC formed. Money goes from the IRA to the LLC bank account, and then you can acquire your real estate.
Okay. I like that. I like that. I'm going to go out of order a little bit here. I see every question though. Curtis, I like this one. Does the cash flow from rentals you buy with an IRA have to go back into the IRA?
Yes, when you buy rental real estate, the cash flow, the rental income, all profits need to go back into the IRA. If you were to personally put that money in your own pocket, that would be considered a distribution from the IRA. Now, maybe you're in your retirement years. Maybe you're 59 and a half or older. Maybe it's a Roth IRA. And so you want to have all of the rental income go back into the Roth IRA, which is tax-free, and then you just distribute from the Roth IRA and pay no taxes. By all means, you can do that, essentially live off of the cash flow tax-free, just like Kevin and Cynthia, who I mentioned before. But if you're under 59 and a half, you need to make sure that that rental income goes back into your IRA.
Okay. Solid answer. Great question. I'm sure there were other people thinking that, so thanks for asking. Okay. Noah, as a real estate broker, am I allowed to lease and manage the property myself, or must I farm it out to another brokerage?
That's a great question. And for Noah, most likely what we would do for them is we would help them with the solo 401k plan, because if they're a real estate broker, they likely have commissions. With those commissions, they can make larger contributions to a solo 401k plan. And then to answer their question, that goes into the services. Okay. Are they providing services?
It's a prohibited transaction? Sorry, it's a game for me. I'm seeing if I can get the answer right.
Yeah, I like it. Yeah. 100 points, right? So if they were, let's say, for example, they were, because they're a real estate broker, let's say, for example, they were handling the leasing activities and they were paying themselves a fee. That would be considered a personal benefit, therefore a prohibited transaction. Now, if they're sticking to the administrative duties, the oversight of the property, and they're staying away from the physical sweat equity, they're not taking any compensation, they should be okay. And remember, services is a gray area of the law. If they took compensation, it would absolutely be a prohibited transaction. So they wouldn't want to do that. They want to stay away from that. I get the question quite often for a real estate agent, can they be the listing agent? So they're not going to take any commission, but they want to be the listing agent. From an administrative perspective, we would be okay with that. It's gray. We can't say yay or nay. The IRS just doesn't give us any direction or guidance on the specific matter. If you were very risk averse, very concerned, you would, to your point, farm it out to someone else. Otherwise, again, stick to that rule of thumb of sticking to the desk duties and staying away from the physical sweat equity.
Okay. That's great. That's great. Let's see. We've got, this is a quick one. Emily said, if I already contributed to my Roth IRA for 2025, can I still set up a solo 401k and contribute for 25 and 26?
Absolutely. So a Roth IRA, traditional IRA, those contribution limits are totally separate from a solo 401k plan. So as long as you qualify for a solo 401k plan, you can make contributions. You can still set up a solo 401k plan for 2025 and make your 2025 contribution. If you're not an S Corp, you're sole proprietorship or LLC, taxes as sole proprietorship, then you have until April 15th to set up the solo 401k plan and do a full 2025 contribution. If you go past April 15th, then you can only do an employer profit sharing contribution, which is going to be about 20% of your net business income. But if you happen to end up in that situation, know that you still have the opportunity to get a little bit of money in for 2025, and then you set yourself up for 2026. For those that are S corporations, you can't do a full 2025 contribution, but you can still do an employer profit sharing contribution up until your tax filing extension deadline, which is September 15th. most people with S Corps are on an extension right now. So that's why I mentioned that.
Okay, that's fantastic. Let's see. Emily, let's see. Well, that's a great question. Emily, so what are the pitfalls of having a rental property inside a Roth IRA or solo 401k? How to maintain a rental property, make sure I'm not breaking into the rules. Let's see. Is it okay to manage the property? We got a lot of questions here. I'll let you tackle maybe the first one.
So the pitfalls, great question. So number one, a traditional IRA, a pre-tax IRA. Now I will tell you, I have plenty of clients that own rental properties in a pre-tax traditional IRA. And the reason why is because they feel strongly that the returns for their traditional IRA investing in those rental properties is going to be better than what they can make in the traditional stock market. Or they feel more confident and they feel it's a more stable investment for them in comparison to the traditional stock market. Okay, so they still invest with traditional IRA. But do keep in mind from a tax perspective, you have a property owned in a traditional IRA, you have rental income coming in. Eventually, if you sell that property, you have gains that go into your traditional IRA that are tax exempt. But when you distribute from the traditional IRA, you have to pay taxes based on your ordinary income. So if you're at a 24% tax bracket in your retirement, if you had just sold that property, not in a traditional IRA, but outside of an IRA, you would have had capital gains tax. For a lot of people, 15%. So some people look at owning rental real estate in a traditional IRA as not as advantageous. If you run the numbers, there can be an argument there. But you also have to look at it through the lens of, do you feel you can make a better rate of return investing in real estate with your traditional IRA in comparison to investing in the stock market? Now, Roth IRAs, this is where Roth IRAs owning rental properties or Roth 401k owning a rental property has a major advantage because you have tax-free income from the rental, you have capital gains, which are tax-free as well, and when you distribute money from that Roth, you pay 0% tax. So the conclusion is this: if we can own rental properties in a Roth IRA or Roth 401k, we would much rather do that in comparison to a traditional IRA. All of that being said, I understand that that's not always feasible for everyone. And some people have a significant amount of retirement money in their traditional, and their strategy is get more diversified in real estate and less diversified in Wall Street. And if that's you, if you're in that situation, don't allow the tax tail to wag the economic dog. I can't tell you how many people have missed out on real estate deals that could have been good for their traditional IRA because they watched a TikTok video where someone said, never own rental properties in a traditional IRA. You need to look at it through your own set of facts and circumstances. And if you feel strongly that the investment returns in that traditional IRA from rental property are going to be better than the traditional stock market, you got your answer.
Okay, that's great. That's super helpful. Let's see. John, if you got to hop off, let me know. Well, I'll keep going and answer questions as long as okay.
I'm good.
Our audience is very hungry. I'm sure you've learned that by now.
That's awesome. I love it. Yeah, let's keep it going.
Suzanne says, let's see. Does the money you lend from your IRA actually leave your account? I would assume so, yes.
Yes. So think of your IRA, your self-directed IRA, your solo 401k plan. It's an account, and it has a bank account. It's an FDIC insured bank account, and you have control to request to have money sent from that account, and obviously money flow back into that account. And so as you're making investments, absolutely. For example, let's say you want to close on a $200,000 rental property, and you're going to use, let's say, a solo 401k plan. So you're going to log into a portal. We provide you with a portal in order to be able to initiate transactions. You log into the portal and you say, I want to wire $200,000 from my solo 401k plan out to this real estate closing. So a wire transfer will be sent from your solo 401k plan bank account directly to the title company. Now you've acquired that property. And now all rents flow back in and all expenses are paid out of that self-directed solo 401k plan. So that's what that flow would look like.
Okay, that's fantastic. Let's see. Alfredo, another question. What are the approximate costs of establishing and maintaining an LLC? Do you recommend using an attorney or doing it yourself? And I don't have the other question in front of me. Somebody else was also asking about the fees for working with you guys.
Sure. So with an IRA, traditional IRA, Roth IRA, HSA, the fees are going to be based on the portfolio value of the account. It's a sliding tiered scale. Any account under $50,000, the annual maintenance fee is $350. Then from 100 to 200,000, it goes up to $500. From there, 100,000 to 250,000, it goes up to $750. So it's a sliding tiered scale depending on the portfolio value. Once you get to $1 million or and up, at that point, it's capped at a $2,500 fee. So on a percentage basis, you pay less as your portfolio value increases. On a dollar basis, it increases because the cost of service and the amount of record keeping and reporting and everything else starts to increase. So Equity Trust charges a little higher fee. So that's what we do as a custodian for IRA, HSA, Roth IRA. And that includes access to your account online. It includes a single point of contact dedicated onboarding specialist. It also includes all annual IRS forms, 5498s, 1099Rs. So some of the more compliance related matters associated with the IRA and the record keeping. Now, for a solo 401k plan, a solo 401k plan is a little different. With a solo 401k plan, you pay a fee when you set up the plan of $1,295, and then every year thereafter, it's $695. And then on the LLC question, if you want to utilize our services to form the LLC, we charge a fee of $1,295. That includes the state filing. That includes the specially crafted operating agreement. We even help you open the bank account with what we call Titan Bank. They're a special bank that accommodates these self-directed investments. You have to follow through and actually complete everything, but ultimately we'll help you get that going. So we have sort of a turnkey process for that. Now, if you don't want to use our services, that's fine. If you want to go to your own attorney, if you want to use your own LLC service provider, by all means, we're not going to stop you. You absolutely can do that. That being said, I would caution you, unless you're experienced with forming LLCs, maybe you're an attorney yourself, and so you're going to do it on your own, that's fine. But I would caution you to try to do a DIY on an LLC, IRA type structure. That could potentially be dangerous. I've seen where folks will try to do a DIY on it, where they go to like one of these online forums and they get an operating agreement. And in the operating agreement, it says that the manager can receive compensation. So you've essentially triggered a prohibited transaction from the moment that you executed on funding that LLC. So it is important, again, to work with a licensed professional, or if you want to utilize, our services, we can help you with that.
Okay, that's awesome. That's super affordable, by the way, and it's really easy to see like how the tax savings would negate that pretty quickly. Let's see.
Exactly. Yep.
Yeah, it's a no-brainer. Let's see. Okay. Alfredo, another question. Is a checkbook IRA truly one where you write a check without any red tape, or a time lag for a deal where urgency is critical to secure the deal? Can I get the money out fast if there's a property on the line?
Yes. So you have a bank account. That bank account is with what we call the bank name is Titan Bank. You have a debit card. You have mobile banking. You have an online platform. You initiate a wire transfer. It's done same day. So there's no submitting documentation to a custodian. There's no lengthy approval process. Think of it as it's just like you having a bank account, just like having a bank account anywhere else and doing online banking.
Okay, sweet. I think we're about to the end of the questions. I'll take like one or two more if anyone has any. Put them in real quick. We're going to wrap up pretty soon. Here was a good one. Chelsea said, can I purchase a property with my real estate checkbook LLC? I don't know if that's a generic term or if that's the name of your LLC, but you can purchase it with the LLC.
Yeah. So real estate checkbook LLC or real estate checkbook IRA LLC, that's sort of like self-directed. It's just a moniker that we put on that. So absolutely, if you set up a real estate checkbook IRA LLC, or sometimes people call it an IRA LLC or a checkbook IRA, there's different terms that are used. It's all the same thing. It's just an LLC. The IRA owns the LLC. The LLC is buying the property. And the individual, in this case, Chelsea, for example, would have full checkbook control capabilities. So when she's ready to buy a property, she simply executes on signing as the purchaser on behalf of the LLC, as the manager of the LLC, and then she logs into her bank account and sends a wire transfer to the title company. She needs an earnest money deposit. She would have a checkbook, so she'd be able to write a check or actually request a check or just do an ACH direct deposit or wire transfer. Typically, earnest money deposits are going to be sent by wire transfer to open escrow anyways, so they can just use their online mobile app in order to do that.
Okay, that's great. Okay, last two. John said, is there any way to rewatch this extremely informative webinar? Yes, we'll be sending out an email either later today or tomorrow morning. So keep your eyes on an email for it. And then Emily said, Emily, great questions. Thanks so much for engaging. If I have a Roth IRA or a solo 401k with Equity Trust, how much help can your advisor provide to maximize the benefits of the account, make sure we don't break any laws, and help with all the things you've been talking about? How much hand-holding do you get?
Yeah, absolutely. So the way we always approach it is we can educate you on the rules, the guidelines, walk you through procedures, instructions. We do all of that as a directed custodian. What we don't do is serve as a tax consultant or advisor. So a tax consultant or advisor, they would look at your unique facts and circumstances, and then they would actually provide advice and recommendations, right, on how you should look at things and how you should do things. So that's something that we don't do. We can't look at your specific facts and circumstances and then provide specific counsel or unique strategies that might apply to your situation that are different than other people's situation. But we're here certainly to provide education, information, give you the facts, tell you what the rules are, and guide you in that fashion. And that would be for a self-directed IRA as well as a solo 401k plan. One of the ways that we do that is through obviously one-on-one type support, but we also do that through education. So for example, when you engage in setting up a solo 401k plan, we actually have an 11 module course that we give you, and you can go through every one of those modules and learn about contribution limits, how to contribute, learn about the rules and regulations. So we have an entire sleeve in there about the prohibited transaction rules. I know a lot of folks had questions about that. Non-recourse loans, how does that work? Case studies and examples. The $500 tax credit that you get just for opening a solo 401k plan. We have all of that in these modules that we provide to you. So we do a lot of it through education where you can learn on your own through those courses. And then obviously the one-on-one support as you have questions. We just can't give any tax, legal, or financial advice.
That's perfect. That's perfect. Thanks for answering that. And anybody still watching, I know we did a webinar, I want to say a couple months ago with Steven from Creative Advising, Tax Strategist. If you didn't catch that webinar, go to our YouTube channel, check it out. That was a really good webinar from a tax strategist. Marries really well with what John's talking about. But man, John, thank you so much for hopping on. It's been really valuable. I know a lot of people got value out of this. Everybody in the chat, if you wouldn't mind, just blow up the chat for John. Tell him thank you. Maybe put a takeaway in here. Share some love for him hopping on here. Real quick housekeeping before we hop off. Usually we've been doing these webinars every couple weeks. We're gonna be doing our next one about 3 weeks out with another one with Shandon Economics. We're gonna have someone from Sam Shannon's team hop back on to talk about, the state of the economy, what to look for in the housing market, and really how to maintain profitability on your rentals this year. It's going to be really good. I think that was our most popular webinar of the year so far. And so our follow-up will be in about 3 weeks to that. But one other thing, if you are new to Rent Ready, I know we have a lot of customers on here, but if you'd never heard of us, just real quick, who we are, what we do, how we help. We're an all-in-one app that lets anyone self-manage rentals, whether you have 1 unit, 3 units, 200 units. I can say with conviction, it's simpler and more affordable than any other options out there. You can collect rent, screen tenants, list units, handle maintenance, accounting. It's simple enough to do 1 or, like I said, 200, starting at about $12 a month. Super affordable. And then one other thing I wanted to mention, something brand new we just released. Is our portfolio performance tool. So you can see how your portfolio is doing at a glance, unit by unit. If you're a rent ready customer, just go into the side under the unit, click on it, and you'll see a performance tab now. So net operating income, how much a property is cash flowing, your cash on cash return, even like your amortization schedule. So you can go nerd out and see, like, at a 30,000 foot view, how are my properties doing? So really you can understand, where to double down, how to improve ROI, and how to invest smarter, especially if you've got a larger portfolio. So something we're pretty excited about. We'd love your feedback on it. Check it out. And then if you're new here and you have questions, check us out, rentready.com/call us. Feel free to book a call with our team. And then one last thing, I will put a link to book a call with John's team in the chat again here, but thank you again, everyone, for hopping on. Thank you for blowing up the chat. And we will see you guys on the next webinar. Thank you, John.
Thanks, Brady. Appreciate it.
All right.
Have a great day,
See you
everybody.
guys.